Hi guys, good morning. Just going to give you a few seconds to enter the room and look, as usual, we'll get this underway. It's fantastic to see some regular names. All right, it looks like we're good to go. So look, good morning traders. It's great to be back with you all. I hope we're doing fine and well and ready to tackle this the wonderful yet sometimes complex world of backtesting. So look, I hope I'm coming across loud and clear and the welcome slide is visible. Any issues, guys, please do let me know and the very friendly support team will try and get you up and running again. Hey, Travis. Look, it would also be great to know how many entertain the idea of backtesting. So how many of us here actually test their strategies, go through that process. If you want to respond in the chat group, that would be fantastic. It'd be most appreciative, so I know where we are, I know what kind of audience we're dealing with. If you've not conducted any backtesting, that's fine. This will be a really good webinar for you to really open your eyes to the importance of backtesting a trading strategy. Hey Tim, good to see you again. So look, now I see some new faces here as well as some regulars, which is good. As a quick intro for newer attendees, my name's Aron Hill and I'm one of the market analysts here at FP Markets. I've been involved in technical trading largely for more than a decade now. So I feel there's not much I've not seen in the markets, but look, we're all students of this business. And I'm continually learning. Every day I learn something new from more experienced traders and more experienced investors. So it's a continual journey for me. Look, so for those interested in a recording of this presentation will be available through the usual avenues, either through YouTube or the main website for FP Markets. You can find that under resources. On the main website, and then just simply click webinars, and you'll find all the archived webinars there with all of the speakers as well. So if you want to look at any of the archived webinars, please do go ahead. Philip, you're saying chat is disabled. I'm not sure why that is, guys. If you can just let me know if you can see the support team have wrote some things in the chat. You should be able to see this. You should be able to see the access, the webinar links and things like that. Can you just let me know in the chat box if you can see this, just Y or N? That would be fantastic. If not, it seems we may have an issue. I don't see anything coming through, so we may have an issue with the chat box. I can only see the Q&A. Oh, you can. All right, Philip, thank you. All right, chat is disabled. I'm not sure, guys, but look, I can see your questions through the Q&A box. So any questions you want to ask, it's fine. I can still see that. You might just miss the links. So I'm not too sure. Thanks for letting me know, guys. All right. So if you can't see the chat box, you can't see the links. I'll try and get that fixed as we proceed. But let me crack on, and any questions, we'll get this. We'll try. All right. So moving on. Disclaimer, guys, as usual. Before getting this on the road, the information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. Simply put, what I say, what I show, or even question here is solely educational and does not represent any form of investment advice. Okay? So we're all on the same path and we know what to expect out of today's session. The current slide demonstrates the topics of focus for this presentation. Thank you for your I think that's your name. Thank you very much for your a comment. I am going to read that out if that's okay. I have been doing backtesting. How do you ensure that live trading result is similar to the backtesting result? The backtesting is usually curve fitted, correct, to obtain a very optimal result. What are some things to note? You are 100% right there. Backtesting and the live trading result is very, very different. I'll explain that as we go through. Pua, I think that's your name. Look, I'm terribly sorry if I have mispronounce your name, but hopefully that I would answer your question as we get through this presentation. So the first thing we'll be looking at is what is backtesting and is it important? We'll kick things off with a description of backtesting and briefly underline why it's important in trading. It's often quite disappointing to see many traders overlook the process of backtesting, or they do not approach it correctly. Well, then, as you can see on the agenda, we'll look at discretionary and non-discretionary systems. Next in the queue, we'll look at the so what it is really is a discretionary based trader is someone like me that really looks at the charts and marks up the charts to take their positions. A non-discretionary system is simply an automated approach. We'll get to that shortly. Methods of backtesting, guys, and this will be the final section really, and what we'll attempt to illustrate here is the varied techniques available for backtesting trading systems, both discretionary and non-discretionary systems. Finally, Q&A, guys. I can take any questions. Look, I can take any questions during the presentation as long as they relate to these slides. All right, so next slide is what is backtesting and why is it important? So look, in my view, backtesting, there should be another slide there. There isn't. I don't know why that is. Anyway, complete trading systems. Right. In my view, backtesting is a process of assessing a trading method's performance based on historical data. There's a number of different methodologies designed to test a system's validity, ranging from a simple manual test to a more complex walk forward optimization for non-discretionary based systems. We'll touch on some of those later. Before putting a strategy to test, of course, you must have a trading strategy. This or should be obvious. You'd be surprised how many lack a complete method and are testing it in, shall we say, half-done form. I won't diverge too much in with this, but please bear with me as it is likely to help some newer traders present. So complete trading systems, as you can see on the slide, require key decisions to be made. Of course, it's beyond the scope of this webinar to touch on all concepts. But as you can see here, I've listed a number of must-know points. I'm just checking the Q&A box, guys, here. All right, so I can see the links in the chat box. I just can't post in the chat box. Can see the links. All right, guys, look, I'm not too sure what's going on with the chat box function. I believe the support team are working on that as we progress, as we move forward. So please bear with us. Any questions, guys? I can see them, so it's not really an issue. You will see the links shortly, though, I believe. All right, so markets. As you can see, markets. What markets will I trade? This is for a complete trading system, right? So are you going to trade just foreign exchange, as you can see here, the FX market, or will you look at major currency pairs, minor currency pairs, exotic currency pairs, or will you look at the equities? So will you look at US equity indexes? Will you look at European equity indexes? All of this must be noted. Another point, of course, well, let me just remove that. Another point, of course, is the entry and exit. This needs to be defined prior to beginning testing, of course. So for entries, will you average into a position? For entries, will you average into a position? For exits, what stops will you use to protect your capital? And what exit strategies will you are going to be employed to lock in profits? So what do I mean by averaging into a position? You'll often hear a lot of traders say this, but they don't really explain it. So, or averaging down. So this basically involves buying or selling at successively lower or higher prices to improve the average rate of the desired long or short position. Yes, I know that's a bit of a mouthful, but as a quick example, look, imagine the euro dollar, say, trades at 120, so $1.20. And you believe that although the pair is falling, it'll rebound from, say, 118. Very basic. By that, you can average into your position as the price declines. So as long as so by doing so, you're long at an average purchase price. Oh, so right. Let me just give you an example. So if you enter long at, say, so price is at 120, we drop to 119, you enter long at 119, then you enter long again at 118, which is the support you believe price will rebound from. By doing so, you're long at an average purchase price, if my maths is correct, at around 1.11850. This is simply found by adding 1.19 to 1.18 to get 2.37 and then dividing that by 2. So that gives you an average price. That's how you average into a position. As price is declining, you enter in a periodic intervals. The opposite of averaging down is averaging up, a term known as, I believe it's pyramiding, which many will know by adding on to winning positions, such as after a technical level break. So you're adding on to your position as it shows favor. All right, risk and money management. Look, as I've said there, it's crucial to understand. Let me just say that without risk management in place, you have a minute chance of being successful in this business. We are risk managers first and foremost, guys. It doesn't matter what kind of trading strategy you have. We are risk managers. So risk management is in place to help keep losses under control. We never know when a black swan event will occur. Black swan event, as a prime example, is the S&B unpegging the euro. You can all remember that. I would assume, and the Swiss markets went crazy. So that's a black swan event. So you really need to understand that risk management is key in this market. This should be applied by both beginners and experienced traders. Look, for money management, if you're interested in money management, we do have a webinar on money management techniques. They're very similar to risk management, and it almost blends. But do look at the archived webinars for that if you're interested. Finally, trading tactics. Look, trading tactics are how we essentially buy and sell in the market, very similar to entry and exit, right? It's the methodology we use. It's what we use to highlight trading opportunities. All right, great. So look, we can all comment in the chat box now, I see. Fantastic. Look, you should be able to comment. You should be able to see the, we should be able to see all the links. So let me know and we can continue. All right, so backtesting, why is it important? Or backtesting is almost validating a trading system. So why is it important? Much like the image on the slide, this should be stamped into your trading plan beside the testing section. I cannot emphasize how vital it is to validate hypothetical trading or investing ideas. Without it, I feel most traders are lost and will ultimately lead to a lack of confidence. And you need confidence to trade successfully in the markets. As I said 5 minutes ago, I found many traders take shortcuts with backtesting and sidestep this process due to it is relatively time consuming. Don't let that be you. Just do not let that be you. I've almost come to enjoy backtesting now. I see it as my license to move one strategy from backtesting into a live environment on a very small account. And that's the way I get I receive the confidence to act with a live account, if that makes sense. So I don't just jump into the live market with $1,000 US account and hope. I look at the backtesting results and I gain confidence from the statistics that I've developed from that backtest. We'll go into that shortly anyway. Look, if there's one thing I really want you to take away from this presentation is that over anything else, there are no shortcuts in this business. As much as we want to become millionaires overnight, there are no shortcuts in this business. By overlooking the backtesting process and then trading live funds, this is something I compare to driving a car blind. You know how to use all of the controls and can feel your way around the car, but you are unaware of the direction the car is headed. You're very likely to hit into a lamppost or hit someone else, or cause an accident without conducting a thorough backtest in trading, like our car driver. You have no idea of its potential direction or performance in terms of trading and risk metrics, of course, and therefore no idea of what can potentially occur in future trading. I emphasize the word potential here as, look, this relates to a comment we had 5 minutes ago from an attendee that said that really no amount of backtesting will ever 100% predict results, as data in the past will never, ever. This should make sense, guys. You're testing your system on previous historical data. Now, it is data in the future will never represent 100% of the historical price data. It's never going to be the same. So for you to expect that your results are going to 100% reflect what's going on in the live market, in your live trading, is not going to happen. And also, we have emotional effects with live trading as well. In the demo and backtesting, our emotions are kept under control when they're not in live trading. Look, I see some questions. Fantastic. Roberta, I will get to those questions shortly. Backtesting is done in a demo account. Again, I will get to that shortly. I'm not avoiding any questions here, guys. It's just this is quite an in-depth presentation, and we'll answer most of these questions. How is backtesting working? Again, another question I will get to very, very shortly. I just wanted to give everyone a brief intro into what I feel about backtesting and why it's so important before we get into the specifics. We now move on to the second part of the presentation, discretionary and non-discretionary based systems. Now, I did not know about this really until I completed the CMT program, and it really, especially CMT level 3, if you're interested, it really goes into detail about trading systems. So there are really three types of approaches. There are discretionary, there are partial discretionary, and there are non-discretionary. Which, to my knowledge, are largely based on either technical or fundamental principles, or a combination of the two. Right. So also, if technically based, look, I'm just trying to think of ways I can describe this. So clearly, I'm speaking solely from the position of a technical analyst here, as that's primarily what I am. There are a number of considerations. To take into account, right? Such as what trading style to follow, be it scalping, be it day trading, be it position trading. Also, if technically based, what type of technical system to adopt? Would you be a trend follower, a momentum trader, a counter trend trader, or a mean reversion, or follow some sort of mean reversion method? So on the other hand, mean reversion trading makes an assumption that prices converge to a mean. For anyone that doesn't understand what I meant by that. Okay, so a discretionary based approach is a trader who works really based on intuition. Now, I don't really like this definition, but this is what most of the textbooks do really go on. Basically, this is an individual that exercise a lot of discretion in their trading decisions. I've personally never met a successful discretionary trader who generates decisions from instinct, right? So that's really no one with a trading system in place. That's what I'm referring to. I find that these types of traders are generally looking for the home run, the big winning trades. I'm not saying successful discretionary traders do not exist, of course, but I've yet to meet one. I would love to meet one. I'd love to pick his brain and how his mind works, but I've never met one to this day. So a partial discretionary trader is really the bucket I feel that I fall into. And what this means is a system that generates a signal, then is acted upon the trader's confidence. So it's hence it's a partial discretionary system. Again, this is what camp I feel like I fit into. I largely determine entry signals via price action techniques, and then at the time the level hits, decide whether or not the setups remain valid. Another partial discretionary application is through an algorithmic approach, of course, a system that automatically provides you with a pattern or a signal to trade, and then the user decides. Again, partially discretionary. The decision is made based on experience and things like that. When you get into non-discretionary approaches, these are the I found these are usually very calm, very intelligent, very educated individuals, and they are very calculated, very, very different to a discretionary approach, where trading decisions are based literally on, with a discretionary approach, of course, discretionary traders are largely based on emotions, I feel. So when I'm talking about a non-discretionary approach, I'm largely talking about trading robots or that work similarly to an EA, right? But can automatically trade on your behalf, so executing entries and exits. This is the non-discretionary approach. Now, with a basic understanding of the trading systems in play, it's vital to recognize that by having some discretion in your, look guys, this is really key. It's vital to understand that when you're trading with you're backtesting a discretionary approach, of course, or a partial discretionary approach, the method cannot be tested accurately. All right, the method cannot be backtested accurately, as a non-discretionary method, I believe, can. What I mean by this is discretionary and partial discretionary methods involve emotional conflicts, okay, that will differ in testing and live environments. Look, I do not need to say this, but as I'm sure we're all aware, but demo trading and live trading are just two different animals entirely in terms of emotional conflicts. A non-discretionary based system really does a good job of avoiding sidestepping things like over trading, premature action, entering before price tests the support level. I'm guilty of this. I've done this on a number of occasions. You enter just before the support level hits. You enter too early, you enter too late, lack of action, and of course, the constant decision-making with discretionary and partial discretionary. The non-discretionary really takes that out of the equation. Why I say the non-discretionary approach mostly sidesteps these aspects is because, look, we are still human. Behind the trading program, we all have emotional conflicts, even with our EAs, even with the automated trading systems we use, and we often still feel the need to modify. So the method, despite having a non-discretionary approach. So there's always that emotional idea to be aware of, aware of. All right. Methods of backtesting. As I'm sure you can imagine, it's beyond the scope of, really, it's beyond the scope of this presentation. Look, I can see a question here. Sorry. Does a strategy expire? I believe it does. Eventually, markets change, guys. We have trending environments. This is why it's so very important to backtest your system through a number. Again, I will get to this, guys. This is why I believe it's so very important to backtest your system through a number of trading environments, be it uptrends, ranging markets, downtrends. All right. So again, I will get to this shortly. I just need to spin things over to my MT4 platform. All right, so just to reshare this, just to make sure we are coming across. All right, so you should have my MT4 platform on screen. If not, just let me know. But if so, I will continue. As I'm sure you can imagine, it's beyond the scope of a single webinar to, thanks, Philip. Excellent. Thanks, Jim, for your compliment there. Very nice. Thank you. So look, as I'm sure it's beyond the scope of this single webinar to detail each method known to man. In terms of backtesting. So I have kept the demonstration largely focused on non-discretionary approach, which is what I really follow. As I see it, we'll then head back to the slides to round things over by going over some non-discretionary techniques to help, shall we say, get your feet wet for anyone interested in the automated trading and testing. So the first method, look, I'm sure you'll all agree, is the most basic, is a manual backtest on MT4. I'm still a big fan of this, really. Also, you must ensure that, look, if you're manually backtesting on your MT4 platform, ensure that you do have the scroll forward tab unpressed, as you can see here. If not, what happens is you'll ping straight to the current candle. So always make sure you have the scroll forward unchecked. Okay, that's the first point. So I'm going to assume for this example we are testing the pound dollar. We're looking at the pound dollar on the H1 time frame, and we're really keeping it very simple today. We're testing the validity of trend line support and resistance. Note that, guys, if you really want to do a back test on trend line support and resistances, check out the pound dollar. The pound dollar is so reactive to traditional trend line support and resistances, and I've not seen them the strategy diminish as of yet. So they're incredibly reactive to trend lines. Anyway, trend lines are generally used to ensure that the underlying trend of an asset is working in favor. And as most traders will also know, that a trend line can establish support and resistances, and this is what we're looking to test. All right. Thanks, Philip. Excellent. Have a great day. Right. So, look, Philip, I just want to say you've not really given me a chance to go through it all, but look, that's fine. Have a fantastic day. All right, so as we can see on the MT4 demo account, we have the trend line resistance. And look, trend line resistances I look for 2 points of contact to really test the trend line support or resistances. So we have a point of contact 1, point of contact 2 there, and we look to trade this area here. With that being said, look, on the MT4, you can simply use F12 to shift forward, as you can see here, F12 on your keyboard, or simply shift F12 to go back. So F12 to go forward when you're testing, F12 to go back. All right, so that's just a little tip that may help you. And look, also, you can also save a screenshot, guys. Really, I would really encourage this, to save a screenshot after every single test trade you take. Note down your entry, note down your stop loss, details of the take profits. So by taking a screenshot, this really allows you to then remove the details from the chart, so you have a free chart to work with, right? Especially if you're using Fibonacci on the MT4 account, right? So you can remove that. You can work with a free chart. So what I mean by a screenshot, let me just bring this into the screen. What I mean by this is exactly the same chart. Look, I hope you can see that, guys. Excellent. What I did, this is one I created earlier. So for instance, trend line support, first point of contact, second point of contact, I would enter short at this point. So according to my trading strategy, I took this trade based on a clear trend line resistance test. As per my trading strategy's rules of engagement, a bearish candle derived from the trend line is sufficient to short. All right, with a stop 5 to 10 pips above the rejection candle. Result, win 2R. So 2R is 2 times the risk. Okay, so we would enter. I'm sorry, my mouse is very slow to react. So we would enter here with the stop loss placed above here, and we would take profit at the next area of support. Quite simple. We would save that screenshot. This is screenshot 3. You would save that in your trading strategy, in your trading log. Very simple, guys. Very simple. So once you find that the trade meets your rules of engagement, you can plot your entry as you saw, plot your entry, plot your stop loss orders, and you can then scroll forward and continue. But look, being a largely discretionary trader myself, I've not had much experience with MT4 or MT5 and the backtesting of non-discretionary trading approaches. The only knowledge I've gained is really my study from the CMT. So however, on MT4, it does allow you to trade automated trading strategies. So you can find this by the View tab, and you can simply select the trading strategy tester. Now, I'm not going to go into this because it's largely, this is for automated traders. But as you can see here, we can select the expert advisor to test. We can select the symbol, the currency pair in this case. We can select the dates from where we want to test. And then we can select the periods, the time frames, and things like that. But look, I really encourage you to look into this if you're interested in this kind of thing, in automated testing. Now, another thing I will bring up is the Forex tester. I do hope some of you, let me just share that. I do hope some of you are aware of this because it is a fantastic piece of software. Now, FP Markets or myself do not have any affiliation to a Forex tester, but this is my go-to software for backtesting my ideas. Validating my ideas, should I say. It's a fantastic, as I said, it's a fantastic piece of software that can really, really increase your learning curve as well as test whether you have any kind of edge in the market. It allows you to test, play like a videotape, as you can see here. So I'm going to release this now. We can increase the speed at this point, and as you can see, the chart goes on. We have data back to, I think it's around 2000, around the year 2000. So it's a really 22 years of data to test with. All right, so you can test this. You can test the trend line support. You can test your support and resistances. You can also change the time frames. Let me just, you can also change the time frames in the, I'm not sure why. There we go. Time frame 4 hours. You can select the time frames up and down. It's very similar to the MT4 platform, right? Very, very similar. Can you test pivot points? I believe you can on the FX tester. I believe you can. We can find out. Let's see. Trend pivot points. You can. I'm sure you can because yeah, we can. There we can. So there we can. So you can actually apply all the different time frames, parameters, daily pivot points and things like that. And I'm not sure if you can get weekly pivot points on here. I think it's only the daily they offer. So continuous, if you want them to continue and show the midpoint. So let's click this on. As you can see, we can test the pivot points. This is the H1. So let's go down to the, sorry, that was the H4. Let's go down to the H1 and add the same indicator. Pivot point, well, that was in, where was that? Trends. I forgot what that was. 1 second. There we go. All right. So look, let's add that, and there we go. Yes. See, we can we can test the pivot points on here. So the R1, the S1, and things like that. If this is something you're interested in, and the great thing is, it just logs all of your trades. So let's take a trade right now. So let's trade. So we're now at the R1. Let's take a short. Again, look, very similar to your MT4, right? So let's take a short, let's sell a standard lot. And the good thing is it's exactly the same volume parameters as your MT4. They've really done a good job here. So let's go one standard lot. Let's place a stop loss above the R2, 62, 63-ish points. And let's have a take profit targets just down at the this area of support here. And let's see how this plays out. Okay, so what you can do, this is a good opportunity. You can decrease the speed to like really nothing. Look how slow this will come across. It will show you the individual ticks that are going on. Whoa, that was a bit quick. So that was a quick move. But look, you can see my point. What you can do is also down to every tick. So it will become very, sorry, that's what I should have said before. You can decrease the speed down to every tick. So this will be now very slow. It's very similar to what you would see on your platform, right? In real time. As you can see, price is moving. Let me zoom in so you can see that. Price is moving. Very similar. The emotions are there, right? I found that the emotions were actually something I really felt with this platform because I really believed this was my license to move to the live trading, right? So this is almost a faster way of demo accounts, if that makes sense. Let's speed things up. So it looks like we're in a bad shape for this trade, selling at the R1. This is not a system I would ever trade, guys, just selling like this. So let's speed it up. Look, so you can see I've sped up, I've increased the speed right to the right to the maximum of every tick. And look, we're going to hit the R2 now, and probably going to take, yeah, we're taking that for a loss. But what happens here, we register our loss, which was, you know, let's see, we can view our statistics here. So this is the great thing about this platform. We have, you know, when you get your MT4 monthly mail from your broker, this has all of your statistics. But look, you have this already available on the FX tester. Total trades, net profit, gross profit. Look, gross profit is essentially the net profit between the gross profit and gross loss are simply the total gains and losses of the trade. Net profit is the difference between the gross profit. So look, we have all of these things. We have maximum drawdown we can look at. Now, maximum drawdown is for anyone that's interested, is simply the maximum loss from an equity peak in your equity curve. And then we also have a number of other statistics you can look at. If you want, I can go over these, what these mean, but if you're not interested, fine, I can leave them. It's not a problem. Let me know in the chat box, guys, if you want me to go over these. I can just quickly, if you want me to. Let me just see. Would you please tell the backtesting software again? Farnham. So the backtesting software is Forex Tester 5. It's quite, I'd say it's quite expensive, but it's not really. I think it's around $200 for what you get for the money you pay and the time you save. It's very good in my opinion. Very, very good. And there's so much you can do with it as well. So I won't go into all the details with the statistics here, but do look those up. It's just really good. It's just a really good platform. Your win rate, your loss rate. So as you can see, we're losing 100% of the time right now because we've only taken one trade. And look, it's just a great platform to really, really hone in your trading skills at a much faster rate. You can take 10 trades, 20 trades within the evening, right? Probably more, but you don't want to overdo it. I found that I was exhausted after, say, 5 trades because it was emotionally taxing for me to trade this way. But I really wanted to get my, as you can say, as you would imagine, a license. So non-discretionary system. So that's really, let's put the discretionary based trading on the shelf for now. And let's look at more of the non-discretionary approaches. So as we would all know by now, the purpose of testing or validating. So here you can see the purpose of backtesting. The purpose of testing or validating your system is to see if it has any use and also locate where any problems may lie, sorry. So when a system is run through a testing program, what you're looking for, this is for non-discretionary automated trading systems, what you're looking for is the parameters selected to fall within a range. Now, I've always looked at this as I would want to see continuity in the parameter set. It should be noted that a parameter set should be ideally small, right? As tests with large parameters can very, very quickly become out of control during the testing process. You will often come across terms, the terms parameters, as you can see on the third bullet point, parameters and variables in automated trading, which are often sorry guys, which are often used interchangeably. Though according to my studies, there is a difference if you're interested, which I believe is best served through an example. So the variables, so let's look at a very, very basic automated system where you buy when price closes above the 50-period moving average. That's it. You buy when price closes above the 50-period moving average. Now, the variables are the closing price for the moving average. The only parameter, of course, is the length of the moving average. Think of it this way. Parameters are something you define and are fixed over time. The variables are the result of the calculation. So a variable is unknown, right? The variable is the result of the calculation and will vary as we move through time. They are, as I've said, they are essentially the unknowns. Also, what did I mean by continuity? Again, a topic best served through an example, I believe. If a 50-day SMA was revealed as the best result in the optimization, and so the 50-day SMA produces the best results in the optimization. This is, again, non-discretionary, guys. This is automated trading. You would want to see continuity. So what a result of continuity would mean is it is slightly better than the 50-day SMA is slightly better than the 49-day SMA, and it was slightly better than the 48-day SMA, and so on. So you're seeing a continuity of your results there. If we have no continuity in the parameter set, what do you think would happen? It would really give you no confidence to trade. So if the parameters are changed from the 50-day SMA and the performance drops rapidly in your trading system, well, this parameter is unlikely to work well in the future. If the parameter set remains similar as we drop from the maximum result, 50-day SMA in that example, we have what is called by many a stable parameter set in the test. Now, what is optimization? Optimization is, and for this, you know, as you can see, I've changed the slide here, guys. So optimizing is simply changing the parameters of a system to reach the optimal results. Now, although this can be beneficial and the results found in optimization may work on future data, system designers must tread carefully here. The concern, of course, is curve fitting, a practice when the optimization program goes about finding the best, the absolute best parameters for the data selected. But with over optimization, all you've really done, all you've really achieved here is fitting those parameters in your trading strategy to the data in your in-sample of your in-sample data. And as you can imagine, the pitfall here is that for the tested system to work, that worked in the in-sample data because we fitted it to the data, to work in the out-of-sample data, your live data, it would have to, then the data in the in-sample batch would have to mimic the past data exactly. It just does not, which is impossible. So the only way to really overcome this that I'm aware of is to optimize the system on what is called in-sample and out-of-sample data, as you can see on the screen there, and test or validate the system's parameter set derived through optimization on a period of data in which no optimization has occurred. And this is called your out-of-sample data. It should make sense, right? In-sample data is where your optimization is carried out, and out-of-sample data is data that the system has never seen before, but we test that on out-of-sample data. As you can see, guys, look, compared to, this is a non-discretionary approach, there's a lot more to take in compared to a discretionary-based system in terms of backtesting. So the different methods of optimization is interesting, right? So we have what's known as whole sample. Bear with me, guys. We have what's known as whole sample testing. And this really, what this does is takes forget the in-sample data, forget the out-of-sample data, forget this line. It takes all of this data and it really just conducts one big test on the whole of your sample, hence the term whole sample. As you can imagine, this leaves no room for validation, really, in terms of an out-of-sample test. And of course, this really opens you. This is curve fitting to a T, in my opinion. This really is you're working with a system that is curve fitted. And this really leads us nicely onto the next trading method of backtesting. Out-of-sample optimization. Now, I've really gone over this already, but I will go over it again so we're all clear. Out-of-sample testing is to take the entire price sample and divide it, as you can see here, into two sections. So my in-sample data is on the left, my out-of-sample data is on the right, two different sample data, two different areas of data segregated onto the chart. Now, the first section should, so according to my studies, the first section in sample data should be around 50%. Okay, I know the chart here is more like 55% for the in sample and 45% for the out of sample, but I'm sure you get the picture. while the remaining 50% for the out of sample data is used to validate your system. All right, something you would not get if you were testing your system on a whole sample batch of data. Look, it's important that the out of sample data can be a portion. Look, you can also do it like this. You can also have the out of sample data to be a portion of the first point of data. So you can have the first 2 years, 8 years, 94 to 98 here, and the last 2016 to 2020. You can use that, and the inner part of the data can be used for your in sample. So you can have outer sample. It's really up to you. As long as it's evenly spaced, you're pretty good to go. Obviously, we want as much data to coverage as possible, right? So to validate our ideas, to achieve what's known as statistical significance, guys. Using longer test data, which includes, as you can see here, bearish markets, bull markets, ranging markets. We want to really, want to include as many trading scenarios as we possibly can. So that, again, bull, bear markets, ranging markets, and things like that. In terms of how many trades, if you're really testing a higher time frame system, I mean a really long-term system, you would want at least 30 to 50 trades in your in-sample data, at least 30 to 50. So for me, for me personally, in my my discretionary based trading, I always go for more. I always go for much more. But with longer, there's always that concern though, with longer testing periods, there is the concern of changing markets, right? So if we backtest a 20-year period, for example, and we optimize the first 10 years, just imagine this is the first 10 years here, and then things change in the subsequent 10 years. So more or less, so a volatile market is found in the in-sample data through your testing, and the out-of-sample data it shows volatility considerably decreased. Then, you know, it proves a really difficult way to test. So I would always go for around 5 years, to be honest, split up 5 years of data. So 2.5 for in-sample and out-of-sample data. Now, the next method for algorithmic traders is a slightly more complex way of trading. Testing. It's called walk-forward optimization. Now, walk-forward optimization is simply another OOS, out-of-sample method of testing that also uses approximately the same amount of data as the regular in-sample and out-of-sample. So let me just go back. So it uses the same amount of data as this type of testing, but really alters the way it tests. That makes sense. The most common procedure is to optimize through a walk-forward optimization is to organize a small portion of data. In this case, as you can see, we have 3 years. Optimization 1, and then test this, validate this, the walk-forward test on year 4. Now, the resulting parameters are then recorded from this walk-forward test, okay, on year 4, and then tested on the following 3 years of data. So we've nudged this forward 1 year. So we then test these walk-forward test parameters on the optimization 2. And then we continue all the way down until we hit year 8. So the final decision about which parameters to select is determined from the list of test results from the walk-forward tests here. So it's the most optimal parameters you're looking for. So the goal of optimization with non-discretionary based traders is to find the most robust parameters that hold up in future data. Okay, so look, I know I've gone a bit overboard with this. Q&A, guys, let me just check the Q&A. All right. If a strategy has a high success rate, is there any need to backtest a new strategy? My question to that is, how do you know it has a high success rate? If you can answer that, reply to me, that would be fantastic. Because without backtesting, how do you know it's got a high success rate? Does a strategy expire? I believe I answered that, but I believe a strategy will eventually expire. Yes. So that's why you need to continually look. I think it was who was it? Mark Douglas, the late Mark Douglas. For anyone that's read his book, Trading in the Zone, he makes a very valid point. Based on discretionary-based systems, to keep an eye on whether a strategy is expiring or becoming less effective, you can just take your testing. So once you reach live trading, you can just take your trading in terms of batches of 20. So you don't take too many trades before you actually know that, so you don't lose too much money. So over each 20 trades, you look at the results and you assess from there. So every 20 trades, you make a new assessment. What else? There was also paper trading as well. Paper trading, demo trading. I would wholeheartedly recommend that, to be honest. But if you have access to the Forex tester, that can really speed up your process. And then following this, move on to a live account with a smaller amount of money. All right. So I don't see any reply to my questions. Ridwan, if you can reply, fantastic. Regarding the high success rate. If not, I'm going to move on because I believe I've answered most of the questions. All right, so look, I know I've thrown a lot at you. Oh, here we go. All right, can this backtesting method be applicable in lower timeframes like intraday or scalping? Of course. I assume you're talking about the non-discretionary approaches. 100%. I've tested lower timeframe strategies in the Forex tester, also on demo account, also in small live accounts. And yes, yeah, of course it can. That's how else would you gain the confidence to trade live without backtesting and having the statistics in your back pocket to have a look at? So really, if you don't backtest, guys, you're going into a live account and you have 3 consecutive losses. What's going to happen to your mindset when that occurs? And that will occur. I don't care what kind of trading strategy you operate with, you will get consecutive losses. What happens to your mindset? We become fragile. We become vulnerable. We start questioning our strategy. What generally happens then? We switch that and we look for another strategy. It's a vicious circle. When all those 3 losses, those three consecutive losses could have been is part of the strategy. And the only way you know that is to have the statistics to back it up. In backtesting, did you have 3 consecutive losses? Did you have 4 consecutive losses? Did you have 5? If so, and the strategy was still profitable in your backtesting, then what's there to worry about? We continue trading. So that's the main, really a great a way of looking at backtesting. Charles, I think that's how you pronounce your name. I'm so sorry Carl, I'm so sorry if I mispronounced it. No, I don't have any tutorials on how to use the strategy tester in MT4. There may be some videos on the the FP Markets main website regarding this. There are some videos, on this, but not one that's been conducted by me. This is something we will be looking at doing in the future, though, for sure, because I know a lot of traders are looking into this. Okay, guys. So look, so any questions, guys? Look, I do hope this has been useful. I really have covered a lot, I know. Any comments or feedback, as you can see, marketanalyst@fpmarkets.com, support@fpmarkets.com. These are the 2 emails you can really send your suggestions or comments to. Remember, a recording presentation will be available through the usual routes, main website, or search under our YouTube account at fpmarkets.com, and you can gain access that way. We also have an FP Markets Telegram channel, guys. You know, something that you can really sign up to, and we're always active on that Telegram channel with setups and market updates and things like that. So do consider signing up to that. I believe we have a link in the chat room, chat box, as you can see. Also, for those who we do have the next webinars, just bear with me. I'm just going to get the list up for the next webinars for August. We only have 2 webinars going into August, guys, just to let you know. It's really the summer months, and this is when traders tend to really slow down. As you can see, my next webinar is on Thursday, the 11th of August, and that is managing the emotions of trading. So if you're interested in the psychological aspect of trading, which you should be, guys, if you really want to be successful in this business, your psychological makeup is incredibly important, guys. So do register for that, and look, it'll be great to see you all there. On that note, I do hope let me just check. Okay, I do see you've replied with 1 to the success rate question I had, and you've wrote 7 out of 3 out of 10 trades. I'm not sure where you get that, but my question is, although you have 7 out of 3, I assume that's 7 winning trades out of 10 trades, which is fantastic. That's a 70% win-loss ratio. Where are you getting that data from? That's my question. Without backtesting, how are you getting that data? How are you able to get that data? All right, thank you, Tim. Cheers. Thank you for coming again. Will you have any webinar on RMT and ICT? I'm not sure what RMT and ICT is, Farnham. I apologize. If you can just let me know, and I'll check if we do have anything coming up. If not, guys, look, just send me an email, and I'll get back to you as soon as I possibly can. Look, on that note, guys, I bid you a farewell and wish you a very, very productive day. And I'll catch you in August, guys. So look, have a great week, great weekend, and I'll catch you all again soon. Thank you so much, guys.